Hi, my name's Andy from the Exit Advisor, and this is the M&A Uncovered podcast. This week's guest is Claire Hancott. She runs a business that specializes in not only accountancy, but in financial controllers and financial directors. And I wanted to get Claire on to talk about the type of help that is available to SME business owners. It doesn't necessarily mean that you need to take on a full-time FD or FC or CFO. So sit back, grab a coffee, enjoy it, and thanks for watching.
So I'm Claire Hancott. I'm the owner of Profit Cash Growth. We're a accountancy firm that specialises in FC and FD support. My background is working in SMEs and corporate. I was an FD for a number of years and did quite a lot of M&A, buying businesses in the UK and Europe and focusing on post-integration as well. And now working at Profit Cash Growth, we serve businesses that are 1 to 20 million. The majority of our customers are either looking to exit their business or to buy a business. So we do a lot of M&A and due diligence sort of work.
Amazing. Okay. And I think most small business owners are going to know what an accountant is. They're going to know that, at the end of the year, they give them all their receipts and it takes them kind of several months normally to get their statutory accounts done and, lets them know how much tax to pay. What are most, I think it's fair to say most business owners, what are most business owners missing in terms of that extra piece, which is the financial directorship, whether that's fractional or full-time?
Yeah. So mostly an accountant, like you say, is going to be focusing on compliance. So they're going to be doing year-end accounts, tax returns, VAT returns, bookkeeping, that type of work. But a FD is focused on performance of the business. So they'll be looking at how to increase your profit, improve your cash flow, grow your business. So really driving the strategy of the business forward and helping the business owner make the business better. That's what our key job is as a finance director. So if you want to keep HMRC happy, you need an accountant. But if you want to keep you happy, your bank balance happy, your partner happy, then an FD is the route to go.
And again, most people, I think that maybe that's something much further down the line, and we need to be at a high turnover to kind of fully get the benefit from that. What do you think is the kind of misconceptions there in terms of at what point in time should people get an FD?
We describe it as there being sort of 3 steps to getting an FD. We see a lot of the time people will have a high street accountant and they'll normally have like a bookkeeper admin person in-house. And that will typically serve a business up to about 1 million turnover. There are kind of variances on that, but a general rule is around 1 million. And then you'll start to feel things become difficult. You'll have questions that your bookkeeper or accountant isn't answering. You'll get numbers that you don't trust. And really the root cause of that is that you're missing a financial control piece. So you're missing somebody that sits over the top and says, what processes have we got? How clean is our data? What reports do we need to be giving to the business owners, the managers in the business, and how frequently to help them drive the performance? And that's actually a financial controller role. That's what traditionally a financial controller does. So we'd suggest that when you get to about 1 million, you'd be looking at getting a fractional or in-house financial controller. And then for businesses that are quite asset rich or have stock, we'd say when you get to about 5 million, if you're a service-based business, then 10 million is probably that trigger of when you need more FD input. But every business would benefit from just having, even if it's an annual sort of day with an FD or a couple of hours with an FD, just to have a look at the strategy and what's happening, where's your cash flow going, leaks in your profit, all of that type of thing. But in terms of getting an FD in-house, we'd say 1 million, get a financial controller. 5 to 10 million, you're looking at an FD.
So it's like a stepping stone before you need to get to the FD stage. And yeah. At what point in time, for like optimum kind of benefit, what point in their like financial year would it make sense to have an FD?
There's no time really in terms of the financial year. January is always a great time in terms of kicking off the new year and having a fresh perspective and fresh energy. But really, there is no good or bad time to start. A good FD will be able to kick off at any point of the year and add value right away.
When we think about the numbers within a business, what are the kind of misnomers that you see in terms of like the mistakes that business owners look at and what they focus on? Like what are they focusing on and what that isn't necessarily moving the needle in any meaningful sense versus what should they be looking at and what should they be planning for, particularly with like your experience in the M&A world? If someone's thinking about selling their business or indeed buying a business, what are the numbers that they should be focusing on?
So a key thing for selling your business, as you know, anybody that's been on the other end and is trying to buy a business, is all about cash. You know,
Hmm.
has the business got cash to support the purchase on day one? And has the business got cash to support deferred payments or any long-term loans that you may take on? And also, has the business got cash to support longer term growth? Because most people don't want to buy a business to just keep it ticking over. They want to buy a business to grow it. So cash is really critical to that. And what a lot of people are doing when they're getting their management accounts on a monthly basis is they're calling the management accounts, but essentially it's just a P&L. It's just telling you the income, your costs, and therefore what your profit is from an accounting perspective.
Hmm.
What a good FD will do, or a good financial controller should be doing, is linking that to the levers and drivers in the business. So if we want to increase profit, what levers do we need to pull? What do we need to go, and what conversations do we need to have with our customers around pricing, or contracts that we got people signed into, or retention of customers, retention of staff, operational efficiencies? That's kind of all the types of things that those conversations should be focused on. So a good FD or financial controller will provide you with the information that you need in advance, and then they'll sit down in a meeting, and that meeting will be focused on the actions that need to be taken in the business. And what that enables a business owner to do is really drive the performance of their business, drive the EBIT up, drive the cash generation up, so that when it comes to exit, you get the best price, and the sale process is as smooth as it can be.
Okay, so there's two things that you've said there. Number one, you talked about cash. Where can people find cash in their business? Is it just in the bank account, or are there other places that people should be looking?
Yeah, there is something called the working capital cycle, and that in a lot of instances will sum up where a business's cash is being held up. And generally it's in one of three places. It's in, oh, sorry, four places. So it'll be in stock. If you're a stock-based business, that's normally the most cash thirsty element of your business.
Hmm.
If you're an asset rich business, then you're going to have cash tied up in assets for sure, because you have an outlay up front, and these assets will be in your business earning you money over a number of years. And then the other places that you can have cash tied up is in your debtors. So any credit terms that you give to your customers. So even if you think, oh, I collect cash from my customers on the day that I do the job, well, let's collect the money in advance. You know, all of those little tips and tricks can speed things up. So that's really where a business can leak cash. But also, if a business has got low margin, you can almost guarantee that they're going to have cash flow pressures. So particularly in like construction, in electrical businesses, all of those types of really competitive low margin businesses, you can guarantee that they're going to have cash flow pressure as well.
The second point of that was going to be working capital cycle, which you touched about there. I don't think a lot of people understand that. So can you sort of take us back to basics and explain what that is and why it's so important?
Yeah. So, in a nutshell, what we try to do with your working capital cycle is we want to understand how long it takes you to take essentially an order or an item of stock and convert it into cash in your bank account. So, we just break it down into the individual stages. So, if you order stock or you pay your staff, for example, when do you pay them? How many days does it take from zero to a payment going out to ultimately your customer putting money in your bank account? And that's what your working capital cycle will tell us, is how long it takes to generate a pound in your bank account. And for some businesses, that will be, you know, if you're a fast moving business, that could be, you know, 7-14 days. But in maybe long-term production, in engineering businesses, manufacturing, you could have a working capital cycle that's sort of like 90, 120 days. And what that's telling us is if it's 90, 120 days, you've got to plug cash flow for 90 to 120 days. So you've got to have enough capital or enough cash behind you to be able to fund the business for that period of time.
And that kind of leads into how you plan ahead financially. So, you know, whether it's the financial controller or the financial director, what kind of things they use and what are the methods and sort of deliverables in terms of, you know, how we plan ahead and how we think about cash flow forecasting.
Yeah. So as a minimum, you want to be looking at like a rolling 13-week forecast for cash flow. That will just tell you that should be on quite a granular detail, you know, what payments are going out to suppliers, when your payroll falls, when your tax payments fall, that type of thing. And that's the most obvious tool that a lot of people are missing. That's about managing day to day and kind of reacting a little bit to where the pressure points may be. But on a long-term basis, an FD would sit and have a conversation with you about your business model. So, for example, what customers are you serving? What are the terms and conditions in your contracts that are meaning that the relationships you're getting into or the products that you're selling and the way you're selling them results in cash flow pressure? So we'd typically do like a longer term forecast, maybe 3 to 5 years, and look at where we think the pinch points may be. And really an FD is kind of saying in 18 months, in 36 months time, what's going to be constraining the business and how do we overcome it?
So it's looking for those bottlenecks before they appear to allow the owner, I presume, just to kind of get back to the day to day and make sure that they're delivering on the strategy.
Yeah, absolutely. And, the business owner is like, they're in the business every day. So they know way more about that business than an FD will ever know. And that's why it's got to be a partnership, because as an FD, I look over hundreds of sets of accounts like every month.
Yeah.
So the knowledge that I build up about different industries, about different business models, about different ways of working really gives you a great insight to be able to say, oh, well, you're similar to customer X that did this and this really worked, or watch out for this because I had another customer that did this and this went really badly. So it's kind of that internal business knowledge that the business owner has, and normally that market knowledge combined with that really deep level of understanding about commercials and what makes a business successful that an FD should bring to the table.
Okay, so you mentioned there that you kind of review hundreds of different accounts. You must see the real success stories and you must see some horror stories, presumably, in amongst all of that. What are the differences between the businesses that are doing really well and the businesses that are kind of laggards and underperforming in terms of the kind of financials?
It's the information that they're looking at. So if somebody is just looking at their P&L, they're literally just looking at the tip of the iceberg of their business. That's not enough to drive a multi-million-pound business from your P&L. It's an important part of it, but you need to be looking at your balance sheet. You need to be looking at your cash flow. You need to have a good suite of KPIs that is really telling you on a live day-to-day basis whether you're on track or not. And so, for example, if you're in an asset-rich business, the number one KPI that I would say you need to be tracking is utilization. So whether that's utilization of a machine, utilization of a team member, of a vehicle, whatever it is for your business, that will be the driver of whether your business stays on profit. And then for a lot of businesses as well, you've got debtor days, tracking your debtors and how much cash is coming in from your customers. So you've got to have these suite of KPIs that really give like a total overview of the business. You cannot just be looking at your profit.
Just going back to this rolling 13-week thing, out of interest, why is it 13 weeks?
Typically because like if you look at like the cycle of like a VAT return, for example, it's quarterly. So in a quarter, everything tends to occur once. So, quarterly rent bills are quite common. Quarterly VAT bills are quite common. So you tend to fall into that cycle. And that just means that it means you're, other than something that happens annually, like your corporation tax bill, you're going to capture everything that way.
Right. Okay. So you're going to see the highs, the good parts of the cash flow cycle and the bad parts of the cash flow cycle.
The
Okay.
longer you go out, the more likely there are to be mistakes, because you're trying to predict the future. So you want to try and keep it as condensed as possible, but without meaning that you don't have time to react should something be a problem.
Okay, that's good. I wanted to talk about that. I wanted to talk about the kind of flexibility in the forecast that an FD can bring versus the kind of real world. Because I mean, you run your own business. Like you have to pivot sometimes quite quickly to a piece of news or macroeconomic situation. Like for example, this war in Iran at the moment, the price of oil has gone crazy, which is going to have a lot of big effect on both businesses in the hire industry and their customers as well as a kind of broader impact. So how do you kind of stay focused on the future, but also remain nimble enough and kind of flexible enough to appreciate that short-term changes might totally screw that cash flow cycle up?
That's where visibility is really important, because you cannot ever make decisions just based off the numbers, and that's the reality. And an accountant often will think that everything lives and dies in the numbers, and it doesn't. I make decisions in my business that don't stack up on paper, but I just know that it's the right long-term decision for my business. So I might take a hit to my profit. I might accept that I need to put some of my personal cash into the business. These things that when you look at them from a mathematical perspective look like bonkers decisions, but the numbers are just one side of it. You've got the commercial acumen, you've got your business knowledge. And so that's where it's an accountant's job or a financial controller's job to paint a picture with the numbers, and then it's for the business owner and the FD to kind of decide, okay, let's pull on all of the levers that we know, all of the pieces of information that we have. The financials is one element of that, but let's make the right decision for the long-term future of the business. And often numbers can lead you down a path of making short-term decisions, which could actually damage the business long-term.
And going back to the data for a second, I think that most small business owners, and even ones around 10 million quid, won't really have like their suite of software will quite often just be limited to something like Xero or Sage. Is that enough? Have you got any tips for small business owners in terms of other bits of software that they should be using, or pieces of software like that okay?
Do you know what? We're a Xero partner, so we heavily push Xero. We think it's a brilliant piece of software for managing the financials. In terms of Sage, Sage is a legacy piece of software. Sage is actually older than me. So if you're on Sage, you're definitely not getting the benefit of modern technology. You can't automate things. There's very limited AI functionality that is integrated into it and things like that. So if you're on Sage, you're probably paying somebody to do processing that computers can now do. So get off Sage right away.
Right. Okay.
QuickBooks is questionable. So for us, Xero is the way forward. But Xero, you need to think of Xero as like the place that you get your data in and store your data. And then what you need on top of that is you need a really good CRM or operational system. So somewhere where all your customer data sits, your customer orders sit, you're tracking, what equipment's going where on a daily basis. So you can bolt those into Xero really easily, and you need something that's specific for your industry and exactly what you're selling. And then the other thing you need is a reporting powerhouse. Xero actually purchased a piece of software called Syft, SYFT. That's a great reporting tool. It's got really cool dashboards in it. You can analyze sales by customer, sales by product, all of that type of thing is kind of in there, and it's a really great tool. So I would say that is the minimum that we'd be looking at in terms of a software stack for businesses. But yeah, Xero is a really great product, and most businesses can scale to about 15-20 million on Xero.
Let's shift it to the kind of M&A side of things. And in terms of getting a business ready to sell from a financial point of view, when should people, I guess two-part question really, when should people start thinking about selling, and financially, what should they be putting in place to make sure that their business is set up as optimally as possible, for a sale and to get through the due diligence period without any nasty surprises?
Yeah, so as a minimum, I'd say that you really need to be thinking 12 to 24 months ahead to sell your business. Most people kind of make the decision and then want to go to the market straight away, but you need to prepare your business so that you can put the best foot forward, and that you're most likely going to get the best return for what is often your life's work. So 12 to 24 months. And what you want to get to a point is that you've got consistency. That's really key for buyers, is they want to know that what they're buying, if you've had X amount of profit in the last couple of years, that's likely to occur again, because they need that for funding and for certainty to sort of lay out some of their money. So consistency is really key, and that comes from knowing the numbers and knowing what is driving the numbers in your business. Another thing that's really critical to do is, a lot of SMEs are, to a certain extent, lifestyle businesses. We're putting a lot of things through the business that you don't see in big corporates, because we're trying to benefit from additional tax breaks and things like that. So making sure that you don't need to stop putting these things through the business, but what you need to do is make sure that you can run a report at any point to say, look, these are all my personal business expenses. These won't exist post-acquisition. And then the most important thing is that the business owner, the FD, whoever is going to be presenting those numbers to the seller, can really paint quite a good picture with those numbers. You need a clear financial story about where your revenue streams are coming from, what's driving your margins, and what's driving your growth as well. And if you can present that to the buyer and paint that story to them, then you're so much more likely to get, firstly, more buyers interested in buying your business, and therefore that drives the price up.
I wanted to touch on sort of your experiences and how important the kind of growth story is in an M&A kind of context. So obviously you've done a lot of your background is in M&A. I think you said between 1 to sort of 25 million pound of enterprise value. So tell us a bit about the kind of financial growth story that you've seen buyers sort of pitch to sellers pitch to buyers?
Yeah, so often people will focus on what we're not doing. They'll say things like, oh, we don't really have a marketing strategy, or there's this CRM and this customer list we don't use. But it's like, it's really important to paint, firstly, that macro picture about where the business is going, where the industry is going, and how that's linking to your numbers. So if you can demonstrate, for example, that there's been this trend, and over the last X amount of years, your business has capitalized on that by using this marketing channel, sourcing these new customers, selling this new product, that says that this is a really well-run business that is in tune with what it takes to succeed. And that's really what a buyer wants. Definitely there are some buyers out there that want to buy bad businesses that have got loads and loads of opportunity in them, but there are also buyers out there that just want to buy really solid businesses. They're able to be the PE backed buyers, and these bigger deals that generally get a much higher sell price. So from that perspective, being able to connect your business with what's happening in the wider economy, what's happening in the wider marketplace, is really, really important to show that you understand what it takes for your business to succeed. And therefore the buyer can also think, okay, this is the opportunity. This is also what we need to do to succeed.
And in terms of like the numbers that are important to buyers, obviously EBITDA gets thrown around a lot, and multiples thereof in terms of the valuation. What's your experience with that? And is there anything else that we as business owners should be focusing on before we're getting ready to sell our business?
Yeah, so some people are really scathing about EBITDA, and one of the things that is really good about EBITDA is it's easy for everybody to understand. So from a benchmark, pretty much everybody can get from their accounts EBITDA, and therefore they've got a good, let's call it a steer at the very least. What EBITDA does enable me to do when I'm looking at a set of accounts is, in most instances, when a business is sold, the debt will be restructured in some way, because how the business is funded at the moment, sometimes it's funded from a mixture of sort of some loans and normally some sort of director loan in the business. That obviously all disappears at the point of sale. So in terms of interest, depreciation, things like that, we don't really care. What EBITDA allows me to do is say, this is going to be my profit. If I'm generating, I don't know, let's say 50k of EBITDA a month, that means I've essentially, in theory, got 50k spare a month to put into growth of the business and to debt repayments post-acquisition. So from that perspective, EBITDA has got a place, but EBITDA is rarely the valuation of the business. The multiplier is by far the more important thing. And there's so many things that go into the multiplier. It's how dependent the business is on the owner, how consistent the revenue is, how quality the margin is it consistent on a month, is it completely like a roller coaster every month, all of those types of things that go into that multiple. So I say, actually, don't focus too much on your EBITDA, focus more on your multiple, and that tends to be where the winners and losers are.
Yeah, that's a really good, and you sort of breeze through a lot of the important parts there, but it is about lifestyle versus having a business with structure and processes, and maybe a senior leadership team, customer concentration, making sure that's not too high. Cash flow cycle is another one. Monthly recurring revenue is a great one, and you've obviously seen a lot of transactions from kind of both sides. What is important for buyers? What are they kind of looking for post-integration? Like, is there anything that buyers could be thinking about or doing during like the due diligence phase and when they're sort of assessing businesses? Are there any kind of tips and tricks you've got there from a sort of financial point of view?
Yeah, so most SMEs, when they're doing the due diligence, they're focusing on the financial and legal aspects of it. But actually, I would say put as much time into asking questions about the team, meeting the team, asking for evidence that processes are documented, things like that. Because what that gives you a really good steer on is the culture of the business that you're going into. I've seen a lot of deals where the business is financially sound and on paper, legal and financial are happy from a due diligence perspective. The risks are low or have been mitigated with the SPA. But then what the business walks into is just absolute carnage. You've got a disengaged team. There's no processes standardized. The culture is just toxic. And immediately from day one, 9 times out of 10, what that means is that people leave either through will or by force. And that just creates this massive distraction. When you buy a business, you want to go in and add value from day one. You don't want to be firefighting and dealing with difficult people. So ask for job descriptions, ask for copies of people's one-to-ones, annual appraisals, how often are people promoted in the business, all of those types of questions, because if you take on a people distraction, that will ultimately come through in the numbers. Without a doubt, your profit will probably take a temporary dip, or you will not see the growth that you need in order to get the return on the business that you hoped as a buyer.
Have you got any kind of horror stories of like post acquisition work where lots of work was done and things looked good, but post acquisition it didn't pan out that way?
I would say for most of the deals that we work on, at least 50%, there's people that exit the business under bad terms. Not necessarily that they've been sacked or forced out, but they quite quickly decide they don't like the new owner, or they were disgruntled already. So I'd say probably about 50% of them, there is a change in personnel quite quickly. And
that's quite high. I thought it would be a bit lower.
Well, maybe it's the type of size deals that we're working on, but I think particularly when you've got an owner-led business, I think it's fair to say that in SMEs, I'm guilty of this as well. I run my business and I decide the culture of my business. And so you've got one person that is key to deciding how people are managed, how people are engaged, how people feel on a day-to-day basis. And a lot of business owners don't really have any leadership or management training. They're just kind of winging it and doing what they feel with their gut on a day-to-day basis. And that does come through a lot in the culture of the business.
So where do you, just diving into that a little bit more, where do you think the ones that get it right post-acquisition, the 50% that get it right versus the 50% get it wrong, is it just luck of the draw, or are there things, sort of patterns you've seen emerging between them that sort of guarantee a little bit of success?
Yeah, I'd say that there's a general rule, and it's how you show up for something is how you show up for everything, isn't it? If you're looking at the numbers and the numbers are a bit messy, then chances are the way that the team's managed is also a bit messy, and the way that the processes are managed is a bit messy, and the way that the marketing's done is a bit messy. Whereas if you're looking at the numbers and they're squeaky clean and you can't find anything wrong, I say it's going to be highly unlikely that you go in and also find that everything else in the business is a complete mess. So if you start to see these signs of chaos or lack of order, lack of thought in any element when you're doing the due diligence, then it's probably a sign that this runs throughout the whole business.
And in terms of buying distressed companies, I just on that point a little bit more, a lot of people talk about buying distressed companies and, they can turn them around and all that kind of stuff. How do you see that? Would you rather someone buy a business that's doing really well, or do you think there's lots of value to be added by buying distressed companies and kind of rolling them up that way?
The reason why the company is distressed in the first place is the key to that, isn't it? If it's a case of a business struggling because, for example, they had one really significant bad debt that took them down, then, that's kind of this one-time event. And you can kind of think, well, there's probably underlying this is actually quite a solid business.
Mm-hmm.
But if there's a lot of things, so maybe there's like some debts with HMRC, there's like bounce back loans and maybe some unpaid creditors, and there's multiple things, then again, chances are this business is probably a bit of a mess. So you've got to be really sure that the assets of the business are something that you can literally from day one start making money from, and that you're not taking on all these legacy headaches. So that would be when looking at an asset purchase is maybe a bit more relevant, looking at like the customer list, the equipment that they've got, that type of thing. So the reason why a business has become distressed is really, really important to understand what the opportunity could look like.
Okay, and on the flip side of that, thinking about synergies, particularly from a financial point of view, if that's possible, when you're looking at a target company, something to acquire, what kind of financial synergies can you how do you sort of assess the financial synergies?
Yeah, so in the simplest of forms, we'd literally put a P&L side by side and say, what are they spending on this and what are they spending on this, and where do we think that there's enough fat to maybe trim people, trim systems, trim suppliers, trim consultants, all of that type of thing. Normally, a lot of it is going to be in your back office function. So you can share like a finance team, you can share a HR team, all of that type of thing. But then also really importantly is looking at, what the combined cash or what the combined leverage of the weight of a bigger group can do. So a 1 million business going to the bank and asking for a loan will only get X amount, but a 10 million business going to the bank and asking for a loan, all of a sudden you're going to be able to get more capital behind you. So all of those things need to come into it. It's not just the synergies of cost cutting, it's the synergies of having a bigger group, buying power, borrowing power, all of those types of things as well.
In terms of like practical tips for business owners, let's say they're not ready to sell their business now, but they're thinking about it in the next 12 or 24 months. From your experience and your kind of financial angle, what kind of tips can you give to people that are thinking about doing that?
Yeah, the first instance I would say is get clean numbers. I think that pretty much every set of accounts I look at, I can find issues. I can find numbers that have just not been looked at by an accountant for years. And therefore, if your numbers are not squeaky clean, you don't really know what's going on in your business. You don't really know how much money you're making. You don't really know how much cash you're generating. And that's got to be the starting point for selling your business. You know, unless you've had a horrible situation like a death or an illness or something which is forcing it, then actually people are making a choice to sell their business and they want to maximize the amount that they get for it. So start with the numbers, understand what all the skeletons are in the closet, and you really need to be doing that minimum sort of a 12 months before you want to exit.
And how important is it to be transparent? I know the answer to this, but how important is it to be transparent versus if you know things in your business aren't particularly great, trying to sort of hide them or shield them or, you know, present them in a better light? What's your take on that?
Yeah, look, if we went to an art gallery, we could stand in front of the same painting and tell a completely different story about it. And that's where a good FD should earn their weight in gold, because it's the story that's put forward. You know, we've all got skeletons, we've all got strengths and weaknesses, but it's how they're positioned and how that story is built and the narrative that's put around it. That a weakness is an opportunity, and a strength is also something that the potential buyer might be thinking, well, is this a real strength, or is this going to, you know, what's the evidence that I'm going to maintain this strength when I buy the business? So therefore, it's not okay to just put the numbers forward. You have to present the numbers and present the story behind the numbers. And that is where the real value comes from.
Okay, so final question. Obviously, you've got lots of experience in M&A. You've been doing this for a long time. The thought of an acquisition to a person that's only ever run their own business and you know maybe got up to a few £1 million turnover, the thought to them of buying a business is quite scary. That's the sort of feedback that I get on you know most people that I go and speak to. What do people get wrong about the way they think about acquisitions, and how do you think they should be thinking about them?
Yeah, often they think that they don't know what's required to buy a business, and there's people out there that can help with that. There's people like myself, you know, LinkedIn, there's books, there's all sorts of places that you can go to upskill yourself. But the best thing to do is just get in some communities really and talk to some people, listen to some podcasts and listen to the real life stories, and you'll realize that actually it's a lot harder to start a business and get a business to a couple of million turnover than it is to buy a business. So if you've been able to go on that journey, I'd say you've absolutely got the skill set to buy a business as well. But just make sure that you are matching the business to your experience. So generally buying businesses of less than 1 million turnover are really difficult because they're so owner dependent. So you are buying a job in most instances. But if you've only run a £2 million business, don't be looking at acquisitions at 20 million, because you haven't walked that walk yet, and you are likely to catch yourself out. So try and look for acquisitions that are very similar to your skill set and the business that you're comfortable with at the moment. And actually you'll find that it's probably easier than you think.
I'm glad you said that, because a lot of people I speak to say, for my first acquisition, I'll buy a small one because then I can sort of dip my toe in the water and learn, you know, learn about the process. But I quite often try and convince them that, you know, buying a business for £500,000 or less than 1 million is not a smart move, because it's going to come with so many headaches and you know, problems that you're going to have to get through. So I'm glad you backed me up on that. Okay, we've got time for one more. So I know you're not a finance broker, but how do, and again, coming back to people I speak to say, you know, I can't buy a £1 million business because I haven't got £1 million. You know, there's a common misconception that you need all this cash update, you know, cash on day one to pay up front. What's your experience? Where does the money come from? How do the sort of structure of a deal work in terms of the monetary side of it?
Yeah, look, there's a lot of these like no money down courses that people can do online. And yeah, the reality is that they're the small businesses that are less than 1 million you can generally buy for no money down. If you are looking at sort of 1 to 20 million typical business, for example, you probably are going to have to put your hand in your pocket, but not for as much money as you expect. Often you'd be looking for businesses like, particularly in your niche of sort of high businesses and asset rich businesses, there's normally a lot of untapped cash in the business. So a really great thing to look for is assets that aren't leveraged. So, and if the business owns assets that are not yet financed or are not financed up to maybe 80, 90%, there's an opportunity to release cash there. There's loads of little tips and tricks we can do with just like getting extra credit terms from HMRC to release a bit of cash. You can look at temporary invoice finance. So there's often a lot of untapped cash in a business. So one of the first indicators that we would look at to say, is this a good target for somebody, is the debt that they've got in the business at the moment. If they're a highly indebted business and they don't have a lot of cash, then you're going to really struggle to release any cash. But if they've got a lot of cash in the bank or they don't have a lot of debt, then it's a great target business because there's loads of opportunities to release some cash, which allows you to make day one payments to the seller. And then longer term, it's about the profitability of the business, making sure that they are generating healthy profits and converting that into cash. And that allows you to make any deferred payments or loan payments.